Hey guys, this is Victor with Alarm CPA. Welcome back. In today's video, guys, we're going to be talking about real estate. Who doesn't love real estate? Today's market, everybody is going very strong on real estate. Prices are going like this, right? So the sellers of real estate are making a lot of money. The buyers of real estate are paying a lot of money, right? So today we're going to be talking about 4 different ways you can save money in real estate taxes. Number 1, we have to talk about 1031 exchange, right? A 1031 exchange or a like-kind exchange. Very easy, very simple in terms of like the information. Okay, all right, see it this way. So basically a 1031 exchange, guys, is going to allow you to defer the taxes to a long-term for a long time, right? So in essence, you are selling a property, right? And you're capturing the profit of the gain, right? And then you are putting that gain into another property, right? You're basically rolling forward the gains into another exchange, property. So you are in essence swapping properties, swapping the gain of this property to another acquisition of another property. So you're pushing it forward, right? You're deferring the gain to the future. It's very important that you do this very carefully, guys. It's very important because otherwise it could trigger a taxable event and you'll end up paying the taxes. So you want to make sure you don't do that, right? So you want to make sure that you talk up to a qualified CPA. You want to make sure that you talk to a qualified intermediary. The intermediary is the institution, the person, the company, the office that will take the gain and will park the gain until you find the property that you're investing in. There's a period of time in which you need to comply with, right? It's not like you're doing this whenever you want to. No, there's a specific rule that you have to follow in order to have the gain, successfully deferred into the future, right? So make sure that you talk to a qualified CPA. You can always give us a call, guys, and we can give you information on how to do this. We can help you. You want to make sure that you talk to a qualified intermediary, and you want to make sure that you comply with the tax law when it becomes time to do the 1031 like exchange. Number 2, guys, the business tax deductions. And this is very simple. So let's say that you own multiple real estate, right? You own multifamily, you own single family homes, you own, different properties, right? So the expenses that are associated for the maintenance and management of these, these properties are subject to deductions, right? So you can write them off. And this could be mortgage interest expense. This could be insurance. This could be maintenance. This could be supplies, office management, right? This could be any expenses that are related to the management and the upkeep of these projects, of these real estate properties that you have, right? So number 1, we have like-kind exchanges. Number 2, we have business expense deduction. And number 3, guys, is the long-term capital gains. You might be asking, what is a capital gain? A capital gain, in essence, is the difference between the sales price of the property that you're selling and how much it cost you, which is the cost basis. So the sales price minus how much you pay for it gives you the amount of capital gain. Capital gain could be either short-term or it could be long-term. You might be asking, Victor, what is the difference between short-term and long-term? It's very easy, guys. Short-term is less than a year. Long-term is considered a year and 1 day, basically 1 year, right? That's the difference. But it's important for you to understand this because if you don't plan the sale of your property correctly, it could cost you more money because long-term capital gains, basically more than a year, gives you a better tax rate than a short-term capital gain. So I always have the conversation with my friends and with my clients that if you have the opportunity to hold the property for a bit longer, if you can structure the transaction for it to be more than a year, do so, because the tax rate is actually lower and you save money. And then you don't want to deal with the like-kind exchange, the 1031 exchange. You don't want to deal with any of that. You basically want to move into the next project. This is the business that you're in and you're okay with paying the taxes, or maybe by having the business deductions, or maybe you don't have too much of a gain, but you still want to pay a little bit less. then defer it to the future for more than a year. And then a long-term capital gain tax rate will be less than the short-term capital tax rate. Number 4, depreciation expense. Depreciation expense is what we call a phantom expense. So let's say that you have a property that you paid for $300,000, right? The IRS allows you to depreciate the property by 27.5 years. So basically you take the price of the property and you divide it by 27.5. And in this case, dividing 300,000 by 27.5, it gives you almost 11 grand in depreciation, 10,909. And you take that as a business expense deduction. The difference is that the 10,909 actually did not come out of your pocket. You didn't have to pay for it. It's basically dividing the property by 27.5. It gives you that expense, and you take that, towards the future. So that's what we call the depreciation expense. It's a great expense because it gives you a tax break. It gives you the opportunity to have a deduction, and when you have a deduction, you pay actually less taxes. So picture if you have 3 million worth of real estate. So these 10,909 basically are more than 100,000, depreciation expense deduction. Now we're talking about a larger number, right? So let's say instead of 3 million, let's say it's 30 million. Then you have what, $1 million write-off in, depreciation expense, or you have a very large number. Or your property can capture what we call bonus depreciation, which gives you additional depreciation. So what I'm telling you here, guys, is that depreciation expense, in essence, gives you an additional expense that are gonna go against your taxable income, and therefore it's gonna lower your taxes. So let's recap, guys. We're talking about number 1, the like-kind exchange. We're talking about number 2, the business expense deduction. Number 3, capital gains. And number 4, the holy grail, which is depreciation expense. We help many clients that own and hold real estate as rental properties, as investments, right? And depreciation is a great way for them to, lower their taxes. 1031 is definitely a great way for you to defer taxes into the future. Business expense allows you to basically the day-to-day expenses of the business to get those deducted. Capital gains, if you're able to push it to, more to a year, more so than short term, it gives you a different tax break. So we help our clients to leverage each one of these categories, and we're successful at doing so. So if you'd like to have additional information, or like to have a consultation or have a strategy session with us, please take a look at here in the description and give us a call, send us an email, and we'll be more than glad to talk to you and find ways for us to help you. And as always, we'll see you in the next one.